Hey everyone, it is Ian, and today we're back with another quick trade idea and topic. Today we're going to be kind of building off the ASHR trade idea that we discussed last week. We're going to be looking at possible overpriced premiums for, you know, irrational reasons, or just the market as a whole, is just a little nervous, so to speak. So today we're going to be looking at ticker symbol EWZ. If you're not familiar with EWZ, EWZ is the Brazilian exposure ETF. So this company, if you actually take a look at this, they basically just hold Brazilian equities. They have a majority of their exposure is in financials, materials, energy, consumer staples. You guys can see all this right here. For the guys on the email thread, I'll have this link attached. That way you guys can take a look. Maybe you can find something a little bit deeper in the weeds. But I think I have a figure of as to why this is happening, and we're gonna go into that in a sec. But first, we're gonna go over just, the general framework of finding these trades, the general framework of finding overpriced risk premium and, or what could be overpriced risk premium. And the way that we do that is, at least the way I like to do it, is in two different ways. Number one, first, I like using the volatility insights tab over here on the right to take a look and see how the, IV for the, upcoming 30 days is compared to the previous realized volatility for the past 30 days. And what we can see is that it appears there's been a pretty solid amount of premium on this over the past, year or so, year and a half. And what that shows is that historically, this this particular ETF, EWZ, typically has a tendency to be overpriced. And what we can also use this for is we can look at right now, and we can see a huge gap between implied and realized. And that is where we can step in and take advantage. So if we go over here to the relative value tab, this is the second thing, by the way, that I was mentioning. This really hits it home of, is this truly quote unquote expensive? And what we can see, guys, is that we're looking at implied volatility relative to realized volatility at a ratio of 1.63 is almost at the peak of its range. This is almost at the absolute peak, like right around the range that we saw, at the end of, 2021 going into 2022, right around March when we saw, the broader market correction. So we have to ask ourselves, well, what could be causing implied volatility relative to realized to be at, at like the highest range that it typically is on this given ETF? It must be something huge. Well, guys, it is, or it could be. And that is the presidential race. And to, basically just summarize it, Luis Silva and Jair Bolsonaro, I'm probably completely butchering both of those names, but anyway, those are the two main presidential candidates. And what we can see is that Bolsonaro has had a significant run up in polling from 31% to around 37% in a matter of a few months, from July to about September. And the thing is that if you actually, take a look at, like who these candidates are and what they represent, Bolsonaro is basically like, kind of like the populist regime, similar to that of, Donald Trump. He's the incumbent, so he is, trying to defend his presidency against, his main opponent, main challenger, which is Lula. Lula da Silva. So, generally speaking, these election volatility cycles, tend to be overpriced and they tend to be overstated. And from what I can see, especially with, a stock or an ETF like Brazil, this doesn't really make a lot of sense. Okay, at the end of the day, policymakers and what these guys are running off of, it shouldn't generate as much of an impact. And if we're seeing a run up in volatility, right? If we're seeing a run up in volatility right now, go back here. This is connecting the data. If we're seeing a run up with Bolsonaro in the past couple of months, and we go back here, and we see this run up in volatility in the past couple of months, we could generally theorize that this is due to Bolsonaro increasing in popularity, and the possibility of him being reelected as president is increasing subsequently as well. If that is the case, right, then it should be, from just an intuitive perspective here, it should just be the same conditions that they're in now because Bolsonaro is the incumbent. So what I personally think is happening here is I think that there's a lot of uncertainty surrounding the Brazilian elections because it's so close. And I think that, with that being said, we should expect this to probably be overpriced risk premium based off, implied volatility just relative to the realized volatility. Now, if we structure out this trade and we take a look at how we would trade this and play something like this, there's a couple things that we can do. First thing that we can really do is just the classic ho hum, very basic short straddle. And that is going to be, right around the $31 strike, considering that EWZ right now is trading at $30.92. Now, another thing that we could do is we can actually go back to the PA terminal tab and go here to the spot vol correlation, and we can see that this has a significant negative correlation, beta of negative 1.64. So, with that being said, we can go back and take a look at this and basically theorize that, well, there's a couple things we can do to mitigate that risk, right? Instead of selling, say, a 31 straddle, one could come in here and sell, say, a 30 or a 29. I wouldn't typically opt for going further out though. When I was, testing this out on my own time, it doesn't appear that this would be optimal because if you're short volatility, right? Like let's go back here and take a look at this. If I'm short volatility, right? And volatility comes down on this, right? Which is our view. That's what we're betting against. Well, based off that spot vol regression that I was talking about, we should theorize from an intuitive perspective that this is probably going to go up. This is going to lead the stock price to go up. And we don't want, it. So if one is, let's say selling like a 29 straddle, right? You're selling it around for the same amount, probably around $3.60, I believe. Well, you're going to lose a lot of money. You have the potential to lose a lot of money there. You may be right, but the structure of your trade wasn't exactly correct. So, in my opinion, by taking a look at, like the skew, and taking a look at term structure, I think the best, most optimal trade here is going to be on just a $31 short straddle, strikes probably in October. While I was looking at this though, guys, it's just a little additional food for thought. Maybe you guys can think of something, theorize something. Maybe this gets your mind turning. When I was looking at the implied volatilities for 90 days, forward vol, 1 year, I really am noticing something awfully peculiar. We're seeing this huge run up in the forward 30-90, but the elections are in October, right? They start October 2nd, I believe it was, when I was researching. So, excuse me. So if that is the case, then and then the elections are over at the end of the month, why are we seeing, 90 days out volatility continue to rally? This is long after over the election is over. It's done. There's an old analogy, like the book is already on the ground, so to speak. The rest of it's just noise. I can't really figure this portion out. I've been doing a little bit of research, but maybe someone can find something. But if not, this could very well be expensive as well, because I do think that this run up that we are seeing, and where the most liquidity is in the options, the shorter strikes, this is due to the elections. So I hope you guys found that interesting. If you guys have any questions, feel free to message me in Discord if you're in the Discord. And with that, I will leave you guys to it. See ya.